Hello, everybody. Welcome to Mediocre Money, and this is your money questions answered. I'm Mark. I'm your host of this personal finance YouTube channel, and I am the least boring, mojito loving, receding hairline, hottest, self conceited, gluten sensitive, sarcastic personal finance YouTuber in the entire Milky Way galaxy. Welcome to Mediocre Money. So, in this episode, I wanted to go over a question that I had from you, my YouTube subscribers. So, I was asked last week, what are the best ETFs for Canadians? So, in this video, I'm going to go over the 8 best ETFs for Canadians. All right, sounds good? Let's get into it. So, first of all, I want to start off with the biggest heavy hitting stock or ETF that you should. So first, I'm going to start off with the heaviest hitting, the best and brightest stock fund that you should invest in. And this is not my recommendation. This is actually a recommendation from someone that you might know, Warren Buffett, who is one of the world's wealthiest men. Maybe, is he the wealthiest? Maybe. Or is that Jeff Bezos now? I don't know. But anyways, Warren Buffett, he knows a thing or two about investing in the stock market. As a matter of fact, he doesn't just recommend this fund, he actually used this in a competition against this guy. This guy is another big shot Wall Street investor, and he basically disputed Warren Buffett's recommendation for just buying a low-cost S&P 500 index fund. And he disputed it, and Warren Buffett said, all right, I will accept a challenge from you. And so I think they took 2 years or something like that. And he said, you can buy whatever you want, and I can buy whatever I want. Whoever has the highest return wins. And guess who won? Warren Buffett with this fund. It's not just the fund that he won this competition with. It is the fund that he recommends all investors, and he said was just as suitable for like 99% of people, which is an S&P 500 index fund, a low-cost S&P 500 index fund. And the best one for Canadians is VFV. So you can see on my screen here, it's from Vanguard. Vanguard was the creator of index funds, and they are just incredible. I have not been able to find lower cost index funds out there. So this fund here, VFV, it has a management fee of 0.09%, which is extremely low. And one of the 3 things that does affect how much money you can make in the stock market is your management fees. So the lower this is, the better this is. So I love the fact that that is so low. It has a dividend payment of 1.4%. So that's awesome to see, just a little bonus on top. And this is actually, personally, full disclosure, I hold most of this. And what I recommend is that you should hold the vast majority of your investments, especially if you're younger, in VFV. This is probably makes up about 70% of my investment portfolio right now. And you can see that VFV, when Vanguard first created the Canadian version of this, they have an American version of it that's been around for longer. But VFV was created in 2012. And since then, it started at $24.60 per share. And now it is all the way up to $75.14 per share. So it has over doubled itself in only a matter of 8 years, which is really awesome to see. Especially with the fact that their management fees are so low. Over the last 5 years, they've averaged an 11.7% return per year. That's awesome to see. And then if you want to see the total annual return history, here it is. In 2019, last year, they had almost 25% return. That's awesome. 2018, 3%. 2017, 13%, 2016, 8%, 2015, 20%, 2014, 23%, and 2013, 40%, a whopping 40%. Holy smokes. 2013 was a good year. So this is why I like this fund the most. However, once people get and own a lot of VFV, they might want to say, you know what, if you look at this graph here, yeah, that's a big dips when coronavirus hit. And even in other years like 2018, just in December, there's a big decline. And a lot of people are like, you know what? I enjoy investing in S&P 500 index funds, and I know it makes up most of my portfolio, or at least it should, but I want to be a little less risk averse. So what does the financial independence community recommend? Well, they recommend having asset allocation funds. Or what all that means is you don't just own an S&P 500 index fund, but you balance it out with a little bit of what we call fixed income funds. So that could be bonds. It might be a real estate investment fund. It is a variety of different things, GICs as well. And all that this does is it smooths this ride out. So you can see that there's lots of ups and downs in here. And so a lot of people say, you know what, this is a little too risky for me. I'll take some of the growth, but I'd like things to be smoothed out a little bit more. And this is completely awesome because just recently, Vanguard has created these. These are what Vanguard calls their all-in-one diversified portfolios, or Vanguard's asset allocation ETFs. So instead of you having to build your portfolio and figure out whether you want 50% fixed income and 50% equities, you can actually just pick a Vanguard fund that already has your asset allocation for you. So we're going to start at the very top here. This is the Vanguard All Equity ETF, which is 100% equities. So if you're looking at getting something like this, honestly, I would recommend just getting VFV because you're looking at like less than half. You're looking at 50% savings as far as management fees go. So if you are going to get an all equity ETF, like why not just get VFV, which Warren Buffett recommends? However, it's still good to have and to know that this at least exists. So this is all equities. You can expect to see the most growth with this, but also the most declines when there are downturns. Vanguard's VGROW, which is 80% equities, 20% fixed incomes. So this one, the ride's going to be smoothed out a little bit more. VBAL is 60% equities and 40% fixed income. So this one's the ride's going to be smoothed out even more. And you can see the risk ratings here. So it is decreasing as we're going. And then all the management fees for every single one of these funds is 0.22%, which I love that. Personally, as Canadians, we should not be buying any ETFs, in my opinion, that have a management fee higher than 0.5%. Anything else higher than that is essentially just robbery. And why would you get those ones when you can have, 50% of the savings by just getting one of these funds with 0.22%? So then you have Vanguard Conservative ETF portfolio, which is 60% fixed income, 40% equities, and VCIP Vanguard Conservative Income Portfolio, which is 80% fixed income, 20% equities. This one's going to be an extremely smooth ride. It's not going to increase in value as much, but you also won't decline as much. Typically, what people do as you age or get closer to retirement, you start off with more equities. And as you get closer to retirement, you start buying Grow and then VAL and then VCNS and then VNS and then VCIP. Essentially, what you're doing is you're just locking in your gains as you're getting closer to retirement and making sure that you don't lose as much money if you come to retire and, COVID-19 happens, because you don't want that. So those are the 5 asset allocation portfolios, which I absolutely love and that you should highly consider investing and vet them for yourself. The next one I want to show you, this graph here is actually all of these asset allocation portfolios. So you can see VEQT, which is the all equities, VGROW, VBAL, VCNS, and VCIP. These are all of those funds put on a graph. So as you can see here, during 2019 and 2020, when we had the great rise in the markets, the 100% equities one, it increased the most, followed by VGROW, then VBAL, then V Conservative, and then VCIP. And then the crash happened. And as you can see, the conservative one crashed the least and is actually higher than the rest of them right now. However, the all equities one, it crashed the most. So that's what they mean by asset allocation funds and the risk profile of these funds. So the more equities you have, or it basically like following something like VFV, the more volatile or up and down you're going to have with your investments. The more conservative you go, the flatter that line is going to be. However, there's a trade-off because you're not going to get as much growth with the conservative funds. So that's just kind of what it looks like. And this is a great example of how, the conservative fund, like this orange line here, It doesn't rise nearly as much as the 100% equities, but look, it did not decline nearly as much either. So as you get closer to retirement, it's better to have a slightly more conservative portfolio. Personally, right now, I'm relatively young, so I'm going in 100% equities right now. I just want to get the growth. I'm not going to be retiring for at least, 12 months. No, just kidding. I'm not going to be retiring for quite a few years. So I'm going 100% equities for now. There's two more funds I want to share with you guys, and these are super exciting funds. The first one I want to talk about is QQQ. And QQQ is kind of, it's a high growth fund that holds mainly tech companies. And QQQ is kind of considered the market standard for gauging how well the tech industry is doing. Bonus of being in the tech industry is that it is extremely high growth because most of them have a very large ability to scale. So, for example, LinkedIn as a platform or Facebook as a platform, it's a lot easier for Facebook to scale to 10 million more people than it is for, say, Coca-Cola to produce 10 million more customers for their bottles. There's a lot more costs with Coca-Cola, and it's just slower as well. So that's why having some tech fund like QQQ is a great idea if you're looking for some really high growth. It is also much more riskier too. So if you look at it back in 2002, so after that little, .com bubble burst, you went to lows of $21 in 2002. So now you can see 18 years later, holy smokes, it's over $244. That is an insane return. That's over 10xing your return in only 18 years. So this is what happens with these tech funds. And this is why if you are young and want to have a little bit more potential to grow, thinking about a tech fund like QQQ is a great option. I'm not actually sure what their management fee is here. It doesn't show me, but I believe it is pretty low. I do own some QQQ, and obviously tech funds, they don't have as high of a dividend, which, you're not really worried about anyways, because you're there for the growth. And the last fund I want to share with you guys is something a little bit maybe controversial, but I personally am super excited about it. It is CQQQ. And you might be thinking, well, what does C mean in front of the QQQ? So that means China.
China. China. China. China. China. China. China. China. China. China.
So this is actually a Chinese tech fund. And looking at the graph here at the maximum, the fund opened up in just 2009 at $25 a share. And today in 2020, it's at over $61 a share. So not as much growth as VFV. However, China is very interesting because over the past 30 years, their growth has just been exponential. Their entire country is really rising up. Their entire country's GDP is just skyrocketing. It's going to surpass the US quite soon. So it's very interesting to be invested, at least a part of your money, in China, because China, these tech funds, if you've looked at them, or these tech companies in China, they've increased their revenues by like exponential percentage in the past 10, 25 years. So looking at China is a good place if you're looking for some potentially very high interest growth. There is not a ton of investments into China right now. However, just recently in the past couple of years, more and more US dollars and even big private hedge fund companies and banks like Morgan Stanley is actually now investing in China and Chinese tech companies. So China is on the rise, and it is important to note that when countries rise, especially as a country's rising to become a new superpower, their citizens are getting wealthier, their citizens are starting to invest, and the rest of the world is also taking note of China's rise and starting to invest as well. So CQQQ is something that I would highly consider if I were you. And something else that you should highly consider is hitting the like button on this video, because it really helps with the YouTube algorithm, helps share my video to more people. I would love to hit 1,000 subscribers this year, is what I think is doable. I'm at I don't know. I think we're nearing 200 right now. And so, how can you help me reach this goal? Maybe you don't want to, and that's okay. I don't care. But it would really help me if you hit the subscribe button. All of that means is that you will start to see a little bit more of my videos sometimes when I post them on YouTube. So if that's something that you like, my subscribers also get to ask me questions, such as this video here. So you get to ask me a question, and guess what? You get a video made just for you. Well, kind of, because I'm sharing it with the rest of YouTube and whoever else is watching it, like you. Thank you. So if you're not subscribed, please subscribe, and I will see everybody in the next episode. I hope you guys have a great week. Good luck with investing. Follow Warren Buffett's advice for the most part. And you know what? Toss a few dollars into somewhere else if you want as well. Do your research before you invest. Do not just take my word for it. Take Warren Buffett's word, and I will talk to you later. Peace out.